Hello, good morning, everyone, and welcome. My name is Rich Brown, AmeriEstate Legal Plan Client Services Manager, and we have with us Mr. Greg Reese, President of AmeriEstate, and we're thrilled to have him because this is a very important topic: corporations, LLCs, sole proprietorships, business entities. Do I need one? Advantages, disadvantages. So welcome, Greg. I mean, like I said, we're lucky to, very, very lucky to have Greg with us because lots and lots of experience in this arena. And we're thrilled to have him with us to help sort this out. How are you, Greg?
Hey, good. Thanks, Rich. You and I talk about this stuff all the time. And, I guess we thought it was about time that we put some of this information out there for our clients so that they have some broad scope information to start making decisions when they're starting a business or looking to upgrade their business that they already started. So let's take it away.
Good. You said it. Do I need a business at all? I mean, do I want a sole proprietorship for what I do? Corporation, LLC? Let's maybe start with the advantages and disadvantages of each of these entities, and just kind of start there on the way to describing, how each works.
Okay, sure. So, if you're starting a business, I mean, anything from a lemonade stand up to, a service business or a retail business or, any kind of business that you can think of, there is often a decision to be made as to whether or not you should incorporate or create some legal structure around your business. Many people, have startup little small businesses and they start them up as sole proprietors. Sometimes they'll go right out of the gate and they'll want to create a legal structure and entity around it. Sometimes they convert from a sole proprietor to a more formalized structure. So maybe we could just start by talking about the relative advantages and disadvantages of creating a legal entity structure versus being a sole proprietor. And then maybe we can walk through the various types of entities.
Just very, very quickly, you said sole proprietor. I might want to go into business with my neighbor too. Well, that's a partnership entity, so that's another entity.
True.
Yeah. So I'm by myself as a sole proprietor. I can be a partnership with some folks. I can be an LLC with some folks or a corporation with some folks. Does that sound right?
Absolutely. And and therein lies the question: which is right for me, right? So maybe today we can do a broad understanding of the different types of entities, how they work, pros and cons, where they fit, generally speaking, and then it gives a good framework and a reference. So let's just start off by talking, answer your first question, sort of the advantages and disadvantages of forming a formal entity, such as a corporation, LLC, partnership, et cetera. So some of the advantages include being able to protect your personal assets from your business activities. Oftentimes, if somebody's going to come after you, sue you for any reason, more often it's going to be in a business environment than it is just in your personal life. Next one, if you create a formal entity, it has an unlimited life that's extended beyond the life of the owner, so they can provide for better continuity should something happen to you. In a formal structure, you can realize greater tax deductions for things such as insurance, entertainment, travel, vehicles, retirement plans, and the like. It provides for a more simple transfer of ownership of assets if you want to sell at some point, exit strategy, or you want to retire, or you should pass away. It's a relatively simple mechanism for transferring the ownership of the business itself. It also involves the ability to change ownership, but not necessarily affect the management of the company. So sometimes you could have management in place that really knows how to operate this, but other people want to invest into it, but they don't know how to operate it so well. So it doesn't mean a change of ownership necessarily has to change the core management of the company. Makes it easier to raise capital. Let's say you're looking for investors. It does tend to make it easier to raise capital and to be organized in that fashion. And it also reduces audit risk dramatically. So the difference between the audit risk for a sole proprietor and any form of legal entity is night and day. Some of the disadvantages, perhaps, of going to a more formal entity structure is that they're more expensive to form than just getting a business license and opening up shop. There are more legal formalities involved that you need to be aware of and pay attention to, and there can be more state and federal rules and regulations to contend with. So that's just a broad outline of the strategic advantages and disadvantages of a formal entity versus just having a sole proprietorship.
That audit feature rang in my ear. That's a nice feature. Nobody likes getting audited, but so maybe start to tell us the various types of entities. We got your partnership, we got your sole proprietorship, we got your corp and your LLC. You're going to tell us a little bit about each of those, how they operate?
Sure. So maybe I should go back to the start at the beginning of maybe sole proprietorships, business owners. We say I'm a business owner. Well, that's great. How's your business organized? How's it structured? That kind of question indicates they want to know, are you a sole proprietor business owner? Or are you an LLC? Or are you a corporation? So let's just talk about the sole proprietor. You want to open up a convenience store. You want to open up a tax service. You want to open up any kind of service or product company online, what have you. If you're a sole proprietor, that means that you're operating in your own name, although you can give your business a name by filing a DBA, usually with the state or the county where the business is primarily located. Obviously, it usually involves getting a business license too. A DBA stands for doing business as. So I could be a sole proprietor opening up my juice bar, right? And I could be, all of the documents and everything is in my name, but I file a registration with the county or the state, usually the county, to say, I want it to be, Jones Juice Bar, whatever it may be. So that's my DBA, doing business.
So that takes a registration with the state?
Well, usually the county is where you file your DBAs. But
the reason I ask is because I know we get tax ID numbers for LLCs and standalone tax ID numbers. A sole proprietor, I believe, operates under their own social, typically, correct, as a tax ID?
Yeah, that's a good point, Rich. Yeah, usually it does, because it's Greg Reese doing business as Jones Juice Bar. But everything flows to Greg Reese, which also means that all of the risk and liability falls on my shoulders. So if something happens, a slip and fall at my business, and I don't have insurance or don't have enough insurance, or I've got a dispute with somebody who's suing me for whatever reason, the juice was bad, they got sick, I don't know what's going to happen. Hopefully we got quality control.
No bad juice.
Before we get started. But I personally have the burden of all the liability for the debts and obligations, which means that if I go belly up and I owe the landlord 6 months of rent, because we just opened up before COVID, and whatever happens, they can go after my personal assets to satisfy all debts, obligations, liens, and judgments, et cetera, like that.
In a partnership, they can attack all the partners equally?
Well, we'll get into that as we go through the entities. Let's stick with one at a time, just so everybody can kind of have a fairly clear understanding. So in the sole proprietorship, there's no legal structure in place, right? It's me running the business, and I might have given it a DBA or a doing business as name, such as Jones Juice Bar. I'm fully liable for all the debts and obligations of the business. No formal legal structure, no separate tax returns need to be filed. All of it's going to be incorporated into my personal returns. My CPA will add certain schedules that report all the income and losses. There is significant audit risk associated with sole proprietors, because the IRS apparently has a history of doing, spot check audits, and now they make them sort of a regular thing, because what they find, or believe they'll find, is that sole proprietors are a little bit more loosey-goosey. They don't have a formal structure in place, so they're not maybe following, consistent rules or GAAP rules or accounting rules or reporting rules that you might typically expect. Doesn't mean that everybody that has a corporation is doing that, but what it means is that they find that sole proprietors will often commingle personal and business expenses and write off stuff, in the business that really has nothing to do with the business. And so they're looking for that kind of stuff. And because they find it on a fairly regular basis, they like to go audit sole proprietors. I have a couple friends right now that just got notified. They're very successful businessmen that have been in business for many years, but they've always operated, started as a sole proprietor and never converted. And now they're getting hit with an audit, and they're just telling me how time consuming and onerous and how intrusive it is. And it's multiple meetings and multiple documents, and they're always asking for stuff. And it takes you out of the game running your business while you're undergoing an audit. So, another aspect of a sole proprietorship, it's difficult to continue operations if the primary owner, let's see, me, Greg Reese, suffers a serious illness or a disability, or I should pass away. It's very difficult for people to step in, like my family members or whoever, to continue the operations of the business, because I'm the one on all the contracts with the vendors. I'm the one on the lease. I'm the one who's responsible for everything. And so if something happens to me and I, for whatever reason, I can no longer conduct business, sign the checks, enter into the agreements, all of that makes it very difficult for the business to continue. And a lot of businesses that don't have sufficient estate planning or other structure in place, they can suffer sort of a cataclysmic event for the family if that were to happen. Another thing about being a sole proprietor is you're considered to be self-employed, and self-employed people are subjected to pay self-employment taxes. Self-employment taxes are, they're paid if you're an employee, but they're also paid if you're a sole proprietor or self-employed. Now, in a business environment where you work for somebody and you're a salaried employee or an hourly employee for a business, those I like to call them the garbage taxes. That when you see your pay stub, you'll see FICA, FUTA, Medicare, Social Security. You'll see all of these little side deductions on your paycheck, right? There's federal tax and state tax, sure, we're all subject to that. But in addition to that, it's the FICA, the FUTA, the Medicare, and all of that kind of stuff. And all of those garbage taxes, is what I like to call them, really can add up to as much as 15.3% of your gross pay.
Wow.
Now, if I worked for an employer, let's say Rich is my employer, and I'm on a W-2, well, Rich, his company pays half my garbage taxes, and I pay half my garbage taxes. So instead of paying 15.3%, I'm paying half of that, and the company's paying half of it. When you're self-employed, you're paying all of that yourself. You're paying all of that yourself on your total income. And the total income is all your revenue, minus your expenses. And so that can really be a detriment. And we'll get into how you can kind of chop that down if you select a formal entity structure.
Good.
And then the last kind of thing about being a sole proprietor is you have limited or no deductions available for things such as the insurance or retirement plans, or maybe a vehicle or things of that nature. So there's a lot more limited things that you can use or spend your money on that you get a valid deduction against your income taxes for. So that's really sort of your sole proprietorship operation. So the rule of thumb on sole proprietors, it's generally going to be a fairly small business. Something that it doesn't necessarily need to be easy or hard to manage. I mean, all businesses are hard, let's face it. I don't care what you're doing, but sole proprietorships are really not something that you would, if you're going to have a long-term business, sometimes you'll start out as a sole proprietorship because, the statistics on small business startups that actually succeed, are fairly low after the first, year and a half to 2 years, realistically. And if you can kind of survive that sort of that breakout period where, you're starting to make revenue, you're starting to generate profits, and this thing is going someplace, at that point, if you choose to start out as a sole, I'm not saying you should, but if you do, you should be considering, gravitating into a more formal entity structure as soon as you kind of see the light ahead. Right.
Okay, that can be an evolution then. Okay.
It could be an evolution. And I'm not suggesting that everybody should start as a sole proprietor. I'm certainly not saying that. But sometimes, the cost of setting it up and the paperwork and the filings and the time, and you just want to get right to business, and you have some worry or concern that are we going to make it? Is this going to thrive and survive? But it could be an evolution. So that's great. So let's jump into some of the more formal entity structures. Probably the least formal entity structure that's sort of a legal structure is a partnership. Now,
Good, here we go. Okay.
here we go. So partnerships are kind of entities that are formed between two or more individuals or parties. And though not absolutely required from a legal standpoint, it is highly recommended that you have a limited partnership agreement where two or more people are engaged in some common business activity. You want to spell out, the responsibilities, how you share in the income, how you share in the losses, how you share in the management responsibilities, how do you dissolve, what events would constitute the need to dissolve the business? How do we go about it? How do we make sure people are treated fairly? What if I die and this business is going? How does my family, get some value out of my interest in the business? So a partnership agreement would spell out most of those things, and it highly recommended that if you're entering into business with another party or another person, that you should have a foundational document for that. Now, there are two types of partnerships that can be formed. One is called a general partnership, and the other is called a limited partnership. So general partnerships are where everybody has equal authority, okay? There's two or more folks or entities involved, and all the general partners have equal authority. But along with equal authority comes joint and several liability for all the debts and obligations of the partnership. So if we get sued, doesn't matter whose fault it is, if it's anybody's fault, doesn't matter. But every partner individually is personally liable for all the debts and obligations, not just your share. So if I get sued for $1 million and I've got one partner, it's not that I'm potentially responsible for half of that or $500,000 and he's responsible for the other. What if he doesn't have any assets for the creditor to go after and I do? Guess what? I would be responsible for 100% of it if that were the case. And then
magic words, personal assets. I mean, your
your business
personal assets are exposed.
Your personal assets and your business assets are exposed in a general partnership environment. It does provide for a pass-through for tax purposes. So typically a partnership will file its own return, but it will pass on all the profits and losses directly to the individual partners. So they individually pay taxes on their share of the profits and losses. Typically no tax per se is paid at the entity level or the partnership level. That's just on the partner. So
you coined that pass-through to your personal returns.
And pass-through simply means that I have an entity. Some entities pay tax at the entity level. Some entities don't pay taxes at that level. They pass through all the profits and losses down to the individual partners, who then report and pay their share of the taxes on any profits that they make.
We heard a lot of tax implications. Very important to have your tax person looped in on these decisions on what entity create and how to operate it for maximum tax advantage, correct?
Yeah, no, having a qualified tax advisor, CPA, somebody who understands business and so forth like that is essential. It really is essential because, oftentimes we'll make the comment, like, we do a lot of business formations for clients. We create LLCs and corporations and we teach them how it works, right? And we create all the documentations and the filings. And it's like GM, we build your car for you.
I love this analogy.
But somebody else is going to basically, once you drive it off the lot, that's your mechanic, right? If
Yes.
it's a car.
Yes.
Well, when you drive it off the lot, your CPA is now the primary person helping to guide the activities of your business. Your budgeting, your taxes, your estimated taxes. What do I get deductions for? Can I set up employee benefits? What's the tax ramification? Do I get some deductions for that? Can I buy a vehicle in my company and get a deduction for that? That's where the CPA is just vital to your your future success and existence. Because
I've loved that you use that analogy many, many times. You know, we'll build your car, we'll deliver your car, we'll hand you the keys, we'll say congratulations, and now loop in your mechanic, your tax person for operational.
right. And it's not that we don't, participate in the future, but
Correct.
it's really driven by you with the help of your, CPA, which is sort of the navigator and the mechanic all at the same time. They're helping to chart the course, and they're helping to keep that thing humming along in compliance, so you don't get audited and things of that nature.
Sorry to digress. You were working on limited partnerships.
Well, I was going to move to limited partnerships next. So general partnerships is one form of partnership. Limited partnerships are another form of partnership. So in a limited partnership, you also must have at least two partners, and you must have at least a general partner as well. Now, the structure here is that the general partner is really serving as the day-to-day manager, right? They're responsible for the day-to-day operations and the management of the business that you've created. The limited partners are typically passive. They're not typically involved in the day-to-day operations, but they may be investors in the company. So they're hoping to make money, in your company by investing with you. And they believe in you, they believe in what you're doing, and they want in, they want to participate in that. So in this framework, limited partners have limited liability, meaning that if something goes wrong in the business, it generally can't bleed over to your personal assets. No creditor of the business is going to go after your home or your savings or your personal investments typically. But the general partner, just like in the general partnership structure, they're fully and completely liable, jointly and severably for all the debts and obligations of that partnership. So the limited partners are passive. The general partners are the day-to-day managing things. Okay. Now, one of the reasons why general partnerships are formed, because maybe, we can talk about a small real estate syndication. Somebody has got expertise in finding, negotiating, acquiring land, maybe developing it or buying and flipping and stuff like that. They've got the skills and the know-how and the management, right? And they're seeking investors to help capitalize that operation so you can acquire property and develop it or build it up or rehab it and hold it or flip it or whatever they want to do. And they are looking to attract investors to help provide the financial piece of the engine while they provide the expertise. Now, in that scenario, a general partner can have a very limited amount of interest in the partnership and still control the activities of the partnership. Okay. So one of the general things that you all hear about is, hey, if I'm involved in an entity and I have ownership in the entity and we have to vote on stuff, whatever it is, generally you need, and it can vary, but generally speaking, you would need 51% of the affirmative vote of the owners, the underlying owners, in order to pass a resolution, whether to go out and do this kind of business, buy this kind of property, expand your business line into a new area, things of that nature, things that affect everybody at large, generally would require some vote of the underlying owners. Now, in a limited partnership environment, the general partner alone could have as little as 2%, 1 or 2% of the entire partnership, but they would control 100% of the activities, 100% of the activities. And that structure is important because if the limited partners don't have experience in this, the general partner does, but the limited partners want to jump in and start dictating like, hey, I want to get a vote of all these people. We don't really think you're the right guy. It's just like, they can't take over. They can't do a hostile takeover of the partnership because that just creates, all kinds of uncertainty. And banks and lenders and stuff, they don't like that too. They get too many cooks in the kitchen. They're like, we don't want to loan you money. I mean, there's too many people that have to be decision makers here. And, if the requisite number don't, fall in line, then something could collapse. So they need a central point of management and control, if you will. So
it's sounding to me like a well-written partnership agreement is highly critical. I mean, we've seen poorly written ones that cause real problems, and we've seen well-written ones, and I always recommend to get a very experienced attorney to write your partnership agreement.
Yeah, in any of these type of formalized entities, you really need to have some underlying foundational documents that are bylaws or organizational operating agreements or partnership agreements, which really specify the roles and responsibilities and what happens in all of the most common potential circumstances that arise. Now, while we're still on this limited partnership concept, where we've got a general partner running the day-to-day and the limited partners as investors, and we talked about how limited partners have limited liability. So if everything goes to hell in a handbasket, so to speak, the most the limited partners could lose is what they actually invested in the company. That's the most you typically have to lose, unless you have personally provided a guarantee for something like a loan.
All right.
But limited partners are not typically required to do that. But the general partner, they're fully liable. I mean, their personal stuff's at risk. Everything that they've got invested is at risk. The whole partnership's at risk, and everything is on them. So what do we typically see happening in a limited partnership arrangement is usually the general partner will form a special purpose corporation or LLC to serve in that general partner role. So now the general
Wow. Okay. Say that one more time. That's an interesting concept. Say that one more time.
Okay. So because the general partner is fully and completely liable for all the debts and they're personally liable too, for all the debts and obligations, then you generally don't want to be personally serving as the general partner. Instead, what you would typically want to do is form a separate entity, either a corporation or an LLC, to serve as the general partner.
Wow.
Now,
okay.
The individual, let's say that's me, I'm still going to have my ownership interest in that special purpose corporation or LLC, but because I'm not the personal general partner, the company is. So the general partnership company is going to have very little in assets in it. They'll have like 1 or 2% of the partnership, not a great amount, and they're not going to have a lot of cash or other assets in there. And so if the partnership gets sued and there's a judgment or liability involved, then they go to the general partner, not me. The general partner is this company, and they say, okay, well, we've got this big judgment, against you for this partnership failure of some sort, and we're seeking to collect all of my assets from you. Well, if that general partner company, that corporation or LLC doesn't really have anything, then there's nothing to collect. So typically, it's very difficult for them to what they call pierce the corporate veil and come after me personally.
Right.
And so that's one way to alleviate the problem that the general partner always has, that if they step in personally as the general partner, then they're fully liable for anything that goes on. So instead, you create that separate entity, and that entity serves as the general partner for the partnership at large. And then I'm still in charge of that smaller general partner entity. So I still control the activities.
It's like adding a layer, right?
You're adding a layer or a barrier, to keep to keep yourself at bay from your potential creditors. And then we'll talk briefly about asset protection as within these entity structures as we move along. But yeah, you're exactly right, Rich. You're creating a layer or a barrier to kind of protect yourself.
Good.
Because business can be risky, right? Okay. So now
migrating to corporations.
Let's migrate to corporations.
Good.
Corporations, how are they formed initially? So you form a corporation by filing what's called articles of incorporation with the Secretary of State. So in whatever business you're starting, you want to file articles of incorporation with a Secretary of State. You actually have the ability to choose a state, which is really probably outside of today's discussion, but at the end I'll get into some of these things. But there's a concept called jurisdiction shopping, where I might be doing business in California or Texas or Wyoming or wherever, actual business, but do I have to form my corporation in that state? No, you don't. You can pick any state you want to initially file your articles of organization. Delaware is a very popular state, for example.
Delaware.
They really pioneered a lot of the laws and the rules set and the protections that are afforded to owners of corporations. But since then, many other states have really beefed up their laws and their ability to protect the owners of the companies, et cetera. So there are lots of good states to consider. There's Wyoming, Nevada, there's Delaware, there's there could be Arizona, it could be a lot of states. Now, you're filing these articles, which basically says I'm declaring, and I'm filing this really one-page document with the Secretary of State that says I intend to file my corporation so it can be legitimate and legal, and then I can start doing what's necessary to kind of build that structure around it and get that business going. And but you also have to remember that if you're doing business in any states other than the one you actually incorporated, because I could do a Delaware corporation and do business in California, nothing wrong with that at all. It happens all the time. But if I'm actually conducting actual business in California, I also have to register my corporation that I filed in Delaware or wherever in California. That's known as a foreign corporation because it was formed outside of that state of jurisdiction. Doesn't mean it was formed offshore in the Caribbean or Europe or Isle of Man or Nevis or any of those offshore jurisdictions. It just means that it was formed initially in a state other than the state you're conducting business in. So if I have a regional equipment manufacturing business and I serve the Western US, maybe 4 states, I could form my LLC in any of those states originally, or I could form it outside of those states, such as in Delaware. But then every state that I'm actually manufacturing or directly have direct business ties and relationships to, I have to notify each state that, hey, I formed this Delaware corporation. I'm going to register that in California, Nevada, Arizona, and Texas, for example. And so that they're aware that you're a valid corporation doing business in California. Why is it important to register it in that other state as a foreign corporation doing business in California, Arizona, Texas, Nevada, et cetera? Well, they're going to probably want to assess, some taxes on you.
Sure. Of course.
What if you have employees in some states but not others? So they're going to want to know that you're maintaining like the payroll taxes and all that kind of stuff, and whatever requirements surround having employees. If you have so many employees, you're subject to this. You have less than that, you're not subject to that. So it all depends. But also, if you get sued, if you haven't registered your company in the state that you're sued and doing business in, then you have no legal standing, meaning that you're not permitted to step up or have your lawyer step up for you to defend against anybody coming after you or attacking you. They say, when the court hearing comes, they say, no, you're not ineligible, you can't defend yourself, which could mean that a creditor could just breeze in, get a summary judgment, and then take that paper and try to collect on assets from you, go through that collection process and short circuit the whole lawsuit thing, or try to prove that they're damaged in some way, shape, or form. So you need to have the ability to be able to represent yourself in a state. So that's one of the key reasons why you do that. Now, keep in mind that there's what's known as a statutory agent. So a statutory agent, especially if you're doing business in multiple states, is somebody that you designate as an individual or as a company. That there's independent companies out there that will serve this role. You have to have somebody inside of the state, boundaries that it can be officially reported on your filing to receive any formal or official notifications coming to the company, such as any correspondence from the Secretary of State regarding your business, any lawsuits that are filed against you. They actually serve your statutory agent, because they're not going to chase you down, in other states or all that kind of stuff. They just have to serve your statutory agent.
So your respective filings in these various states are public record, and this statutory agent is the go-to person. If I'm looking for Greg Reese's company, I'm going to go through this statutory agent that's on file with the Secretary of State as a matter of public record, so I
Yeah.
can always find you.
And that's considered legal notification of service if it happens to be a lawsuit. It's not always about lawsuits, but
Right,
it could
right.
be any
We
official
get
government-
notices for fees that we owe, taxes that we owe, things like that.
Yeah, or registrations that are delinquent, or
Yes.
forgot to renew your register, whatever it may be. But they go to that statutory agent, and then their responsibility is to notify you, right? So, hey, we got this document or this summons or something for the company, from another state, and their requirement is to notify you. So you kind of got to have that in place, for that purposes. So, one thing about corporations is that there's two types of corporations. So we talked about two types of partnerships, general and limited partnerships. Well, there's two types of corporations that you can look at as well. One's known as a C corporation, and the other one is known as a subchapter S corporation, or sub S for short. So let's talk about C corporations to start with. So C corporations are the one that we all, because what a lot of people know a very limited amount about corporations. What's the difference between a C and a sub S? Well, the C corporation is subject to dual taxation, double taxation. The S corp is not. Okay, so that's going to be one differentiator between a C and an S corp. But let's kind of walk through. So all corporations are initially filed. When you file a corporation, it's initially going to be assumed that you're a C corporation. Okay, so what are some of the features of a C corporation? Number one, it can have an unlimited number of shareholders. Okay, it can have all types of people and entities serving as shareholders. In other words, individuals, different entity types like other corps or trusts, even foreign nationals can be shareholders of your company. So, for example, the big companies that you hear about on the business reports and stuff, and the Wall Street, and the Fortune 500 and all those, generally those companies are formed as C corporations. And can you invest in those corporations as a U.S. citizen? Sure. What if you live in Europe or Asia? Can you invest in a U.S. C corporation? You sure can. Can we also invest in C corporations that are formed in Japan or China or Germany or other jurisdictions? We sure can, because they can attract capital and investors from all over the world. And my living trust could be a shareholder. My own little corporation could actually buy a piece of another corporation in terms of shares of stock. I could own it in my name, my wife and I, all manner of things. So with the C corporations. Now let's go back to the two levels of tax. So corporations are separately taxed on profits as though the corporation itself was an individual. And so that's one of the aspects of the C corporation. And then the shareholders, they receive earnings of the company reduced by the taxes paid at the corporation level. Usually they're paid in the form of dividends. It's called dividends. That's a pro rata distribution of the earnings of the company that are declared by the company to pay out to the shareholders. So they typically don't pay out 100% of their earnings from year to year, because C corporations are almost always involved in taking profits and reinvesting a certain amount of those profits back into the business to keep it growing and make it more valuable, because you're buying into it not only to get some dividends and some income maybe coming your way, but you're also looking for the share price to increase over time, right? You want to see, if I bought a stock for 10 or $100, I want to see the value of that share price go up over time. That's part of why I'm investing. So they'll take some of those profits, they'll plow them back into the company to generate even better returns and better value for the shareholders. At the same time, they may pay you dividends from year to year, which are not guaranteed, by the way. They have to be declared by the board of directors. But that's the two levels of taxation at the C corporation level. First level is corporation pays taxes on its profits. And keep in mind, the tax rates for corporations generally are a lot lower than the individual tax rates that you and I pay and report on our 1040s. But it is what it is. But then when we get our dividends, then we have to report that on our income taxes, and we pay taxes on dividends. And of course, if we sell our stock and we make a profit, we have to pay maybe capital, short or long-term capital gains, et cetera. So what else? The other thing about the dividends, the shareholders, when you get dividends, in a partnership arrangement, if the company has losses, actual losses, or just tax losses, maybe there's depreciation or other things. So maybe there's a loss that gets distributed to you as a member of a partnership, right? If there's losses on your K1, you can apply those losses against other income. So you can kind of offset those. And that can be cool to have that. In a C corporation environment, if the corporation has a net loss or a tax loss, maybe they invested a bunch of money in R&D or exploration or something like that, and they get a bunch of allowances or depletion write-offs or depreciation write-offs. So they may not necessarily operate at a loss, but for tax purposes, it's seen as a loss. Now, when you get a dividend as a shareholder, you only report positive dividends, cash that you get. If there's a tax loss, it stays within the corporation. They can offset future profits at the corporate level, but you don't get to take losses and offset other personal income at the C Corp level. Okay. So that's kind of two key differentiators between a C and an S is the dual taxation of the C, and you have to pay taxes on your dividends, but you don't get to benefit from any tax losses that you can apply to other income. So that's sort of a C. Now, C corporations are, kind of a lot, they're sort of the most flexible type of structure because you can accommodate a lot of different things. For example, you could have different classes of stock issued within a C corporation. You could have common stock, preferred stock, convertible stock, and you could have different rule sets for each class of stock, right? You could have a priority return before the common stock holders get it. You could have convertible, which means it could be converted to preferred stock or corporate bonds, at your discretion over time, which may give you a little bit more flexibility. If one side's performing better than the other side within the company, you may have a chance to say, I want to exchange my shares here for this type of share because I think those are actually performing better, and I might want to do that. So you can have a lot of flexibility in terms of how you create the stockholder arrangements, and you can have voting and non-voting shares. Voting shares might be more valuable because you have a little bit more say in the company. Non-voting shares maybe not always the case, but maybe less value because you don't have a voting voice in the operations of the company. Also, the S corporation probably provides the widest variety of management and employee benefits that can be added and treated on a tax favored basis. So there's a lot like defined benefit plans, plus the 401k, plus key management benefits like key man insurance and private pensions and different things like that, just to incentivize top management to stay with the firm and help it grow. The C corporation provides probably the widest variety of benefit structures that you can add into the corporation, if you will.
Sounds like the C corp is a pretty high level, distinction, and with the complexities involved and the options involved for a more sophisticated company than a mom and pop, for example.
Well, it can vary, but maybe a couple key considerations here, so we don't get too far into the weeds on the processes. Generally speaking, if the company intends on a regular basis to plow most of its profits back into the company, then as opposed to just passing it all out to the shareholders every single year, because if they had to do that, they may not have the capital to keep propelling the company forward, reinvesting in new equipment, new technologies, new exploration, new R&D, all that kind of stuff. So if you're planning to plow a lot of the profits back in on a regular basis, not just a one-time deal, then a C corporation may make sense. Sometimes you may be a very highly compensated professional. Maybe you're a doctor or a lawyer or something like that. With your accountant's advice and guidance, it may make sense for you to form your practice. And you may only have 5 people in your practice. You may have yourself and 4 employees. Who knows? It could be a physician's group. But it may provide you the ability to create extra retirement benefit plans that will benefit your employees, but primarily will benefit yourself with great higher limits. So you can sock away, like, you know, how an IRA, you can, I don't know, what is it, $4,000 now you can do it in IRA. So it was $2,000 forever.
Yeah.
But in a 401k might have a $14,000 annual limitation to how much you can contribute to a 401k. Well, you can set up other types of pension plans where you can put aside 50,000, 100,000 more, right? Deduct it from taxes and create a separate, a separate pension on top of it, where you can sock a lot of your profits away and deduct those from so you can do it pre-tax. So
Terrific.
it may be that maybe because you are a highly paid professional or other person of sorts, and either you want to plow a lot of money back into the company on a regular basis, or maybe you want to create additional tax saving benefit structures that will primarily benefit yourself as the owner. But of course, you're going to have to provide some of that for the employees too. But oftentimes that can make more sense. So maybe that's a guideline for when you want to consider being a C or an S. Okay.
I'll move us along. And then we have the sub S classification.
We have the sub S. So the sub S corporation, you're filing the same way that you file a C corporation. You have to file articles of incorporation with the Secretary of State. You have the same requirements to file in other states if you're actively doing business. One of the things that people often wonder, well, what if I sell on the internet? What if I sell online? Do I have to register? And I could have somebody once a year that buys for me in North Dakota or Maine or something like that. Do I have to register my corporation there? Not typically. When you're an online business, there's a whole set of different rules, but just understand that you're not typically required to register and pay a registration fee and do tax reporting in every single state that you're in. But that's something that, definitely steer you back to your CPA and get the lowdown on all of that before you get too deep in your business. You want to understand this stuff by having some pre-launch, consultations with your tax team and your lawyer, et cetera, et cetera. So you still file. And as I said before, every corporation that's newly created by filing their articles of incorporation is assumed to be a C corporation. But if I don't want to be taxed and treated as a C corporation, I can file an election, which is known as a sub S election with the IRS to say, I'm electing to be treated as a sub S corporation. And then the following discussion and rule sets would apply to me. I don't want to be subject to this double taxation rule. Okay. So that's a sub S election. Okay. So in a sub S corporation, it's a little bit more restrictive than a C. In other words, there's only one class of stock that can be issued, right? You can't have preferred, common, convertible, and all of that. One class of stock for everybody. You can have no more than 100 shareholders.
Oh.
Okay. No more than 100 shareholders, where a C corporation can have unlimited. There can be some restrictions on who or what could be an investor or a shareholder in the sub S company. In other words, generally they don't permit foreign investors to invest in a sub S company. An LLC probably can't invest in a sub S corporation. Certain types of trusts cannot invest in that. Now, most living trusts, but you would want to make sure by talking to your attorney and your CPA, if you have a revocable living trust, most of the time, a revocable living trust qualifies as a permitted shareholder within a sub S environment, but it's something that you want to double check with your estate, planning attorney if you have that, and that's how you want to hold your shares, which I kind of recommend holding your shares that way anyway. So that's the type of investors, no more than 100. Now, a sub S corporation, from a tax perspective, is treated much the same as a partnership is. It's a pass-through entity. So
that's key.
All the profits and losses at the company level are reported to all of the individual shareholders. So you're going to receive a K-1 with your proportional share of any profits or losses. And you, unlike the C corporation, you benefit from the profits, as well as the losses. So if there's tax losses, they say, hey, look, you have a negative amount of $10,000 reported because of either the business was down or they had investments they got extra write-offs for. So they're going to pass that tax break on to you. Now I can use that 10,000 loss to offset 10,000 of other income that I might generate outside of this, you know.
Pass through right to your personal tax returns.
Pass through right to your personal tax return. So you get to share it in both of those. And so
Terrific.
that's you know, that's one of the features of the sub S. So the corporation would typically file a return, but the corporation itself would not typically owe any tax.
Understand.
You may have an annual fee to the state. Just a quick mention on filing a formal legal entity when you have to register with a state. There's usually going to be a filing fee, which is the filing fees are not that much, right? But it can cost you anywhere from, you know, $1,200 to $2,500 to, you know, typically. Some attorneys charge a lot more, but typically you should be able to get a corporation filed and formed for that amount of money. You're going to have some fees associated with getting guidance from your CPA up front, which is well worth the money, let me tell you. And then some states will impose an annual fee. And, you know, most of them are fairly reasonable, from $0 to $50 a year, just to be, you know, an active, you know, entity recognized within the state. Other states like California, they charge like an $800 annual fee. Other states approach that, but I'm not aware of really any other states that charge more than that. That is a tax deductible expense, you know, for the corporation, sure. But there can be some ongoing fees associated with being an active formed agent operation. But I also, you know, just want to reiterate that whether you have a partnership, whether you have a corporation, or even an LLC, which we're going to talk about, there's all going to be an underlying document that sets the rules for how the company functions and how it treats different situations, like who gets paid, when do you get paid, when do you hold meetings, what if somebody wants to sell, what if somebody dies, you know, what if the company, you know, what are the events under which the company will see, you know, go out of business or wind up or whatever. So all of those things. So everybody has some rules. You know, it's like playing a game of baseball. You know, there's rules around it, and everybody wants to know what the rules are so they know how to participate appropriately within the structure. Okay, so
which brings us to this entity called an LLC, a limited liability company.
Yeah, so this will be the last, you know, major entity we're going to discuss here, and that is limited liability companies, or LLC for short. So LLCs are, and what did I do with my my notes here? So I don't have my notes, so I just have to go on memory. So LLCs were formed more recently. They've been around, I don't know, they've been around 50 years now, 40 years, maybe not even that long, but
here comes your notes, by the way.
But there was a need seen because, you know, corporations work really well, you know, for certain things. Partnerships work really well for certain things. And so, you know, people kind of realize that could we have a blend of those two where we can maybe theoretically get, you know, some of the best of both worlds, you know, in a different structure. So therein was born the limited liability company, and the limited liability company is more or less a hybrid between a partnership and a corporation, right? So what it does is it provides limited liability for everybody, the people managing the LLC, as well as the people that are just invested in the LLC. It also provides the ability to elect you know, one of a couple different tax structures at the company level. You can either elect to be taxed as an S corporation, or you can elect to be taxed as a partnership. There can be some fundamental differences in activities that they may be engaged in that would steer you one direction or the other, but it's a fundamental question. And I don't even, you know, for this purpose, because it's such a fundamental question, without trying to seemingly steer anybody as to what they should do from a tax election on an LLC, definitely you got to talk to your CPA about that, because For the most part, they're still treated as pass-through. So ultimately, the profits and losses will pass through to you. But it could be a question about, would one election give me the ability to add more benefits, employee or management benefits, versus another? Would there be any difference in liability? Things like that. Definitely a fundamental question that you want to know the answer to before you fund or form your limited liability company. So now in this case, much like the corporation, you're going to start the LLC by filing what's known as articles of organization. So the corporation articles are called articles of incorporation. The LLC files articles of organization. So the LLC uses slightly different terminology, which represents virtually the same or similar thing, right? So articles of organization are the rule set I just talked about. How does this thing going to operate? It governs the conduct and the activities of
adding managers, subtracting managers, adding members, subtracting members, dissolution.
Yeah, it also, creates its own bubbles about what if I'm a member or a manager and somebody is suing me? Can they foreclose on my ownership interest in the LLC? I mean, it governs that. It's like, no. It's like, the rest of us that are in this company, we don't want your creditor involved in our business. That's your problem, And so the LLC operating agreement is going to create some barriers to entry because you don't want people that come into your company that you haven't invited, right? That don't have any right to invest in your company. They'd have to be approved by the rest of us that are, right? So there's some things like that are involved. But similar formalities, filing with the state, you've got an operating agreement, which is similar to the bylaws that govern a corporation. So it's the same type of rule set, but they're just called something different. The shareholders. So in a corporation environment, the owners of the stock are called shareholders. The owners of an LLC are typically called members, right? But members and shareholders are virtually the same thing, same rights and privileges, et cetera. It's just got a different terminology because it's a different type of named structure. Now, an LLC can either be managed by managers or it can be managed by the members. So again, we've got a common theme going through here, right? Corporations, 2 types. Partnerships, 2 types. LLCs, 2 types. Manager managed and member managed. So oftentimes, if it's a very close-knit group, like Rich and I, and we want to do some real estate investing together, and we want to do it under the umbrella of an LLC. We may form a member managed LLC because we're both actively involved and we both want to have independent decision making, to sign contracts and deal with banking and meet with the inspectors and the contractor, whatever it may be. We both have authority because the members manage the company. The members manage the company. So we might do a member managed scenario, which means that we both have equal authority, kind of like a general partnership, but without the liability that comes in a general partnership. So we could be members, but we have limited liability. If we formed a general partnership, we both have personal liability. So if you were going to go off into a business like I just described, wouldn't you think that the LLC might be a better structure for you? Because you're avoiding that liability component that the general partnership brings to bear. So we see the LLC. This is one of the reasons why LLCs were created in the first place, because they were trying to figure out, and it had to come through statutes and laws created to achieve this. But now we can do the same kind of business that a general partnership could engage in, but we can shield ourselves from all that extra liability. So that's an advantage of the deal. Now, the other kind of LLC is what we call a manager managed LLC. And that is kind of like a corporation environment where the shareholders will typically vote to elect the management team, right? If you guys own stock on, just in your investment portfolio, you get proxies all the time. Like, hey, the annual shareholder meeting is coming up and here's what the board recommends to serve in the following roles: president, vice president, secretary, etc. And they're asking you to vote, because the shareholders get to vote on the management team. Same with the manager managed LLC. The members who own the individual ownership interest, they get to vote on who the manager or managers are going to be. So in this structure, you can have both managers and officers, or you can have just managers or just officers. So if you want to be even more formal and have president, vice president, treasurer, secretary, all of these types of officer roles, if you're a little bit more robust of a company, maybe there's some advantages to that to create accountability within those role sets and departments. Or you can just have the power of conducting the day-to-day operations in the hands of the managers. So in a manager managed LLC, the members do not have day-to-day authority. They're not typically signers on the bank accounts. They don't have the ability to find the company for loans or other services or sign contracts on behalf of the company. That's the job of the managers. So you may have a manager managed LLC where you have specific person or persons that are going to run the day-to-day and of course do all the reporting back to everybody else, but that's sort of a manager managed environment. Keep in mind that corporations of both types, LLCs of both types, do typically have to have their own tax ID number or employee identification number, EIN. Limited partnerships oftentimes will, but then the members have their own, your social security number is attached, typically if you're an individual owner with your membership interest. So, but the LLC from a taxpayer status, is that election. So we talked about that tax election. You can be, but there's really 3 tax elections available to an LLC. If you're a single member LLC, that's really another form. But a single member LLC means there's just one person owning the company, or maybe it's a husband and wife, and legally from a business standpoint, a husband and wife are treated as one, so it could still be a single member entity. If there's only one member or just a husband and wife, then you're automatically considered a disregarded entity. The LLC does not have to file a separate tax return to report its profits and losses and activities. All of the profits and losses are actually reported on your federal tax return, your 1040. So that's a disregarded entity, which only applies to a single member LLC. If you have a multi-member LLC, meaning like Rich and I, let's say, are both members, that would be an example of a multi-member LLC. We could be manager managed or member managed, but our LLC will have its own tax ID number. In both cases, it will. But with our LLC at a multi-owner, or multi-member, will have to file its own separate tax return and then report the share of profits and losses that accrue to me and to Rich or any other members that we may have in the mix here. So,
boy, I'm hearing so loud and clear that the tax person needs to be really on board and really participate on the creation day one, and then the maintenance, ongoing for best tax advantage.
That's right. And
I'm moving this along. We're going long. I'm so sorry. But we're moving this along. I just wanted to go to a very, very high level and probably end up being another webinar someday, but asset protection. So I wondered, Greg, from a very high level, how do these entities, contribute or maybe in a partnership arrangement, not contribute to a level of asset protection by creating these and operating them appropriately?
So, we've kind of touched on that a bit, through this presentation, but the idea of creating a more formal legal structure so that you have limited liability. In other words, the idea is that you want to separate your personal affairs from your business affairs, so that there's ever an attack against you from one direction or the other side is generally protected. It's almost like, I use the medieval fiefdom and the castles analogy for this is like you're a large landowner.
I love this one too.
Medieval England, they generally build these castles, which are fortifications, and they're cities unto themselves. A lot of commerce goes on inside of these castles. There's the barber and the horse shoeing and different farmers and different people, and they may farm the fields, but they come inside the castle walls for protection, right? So they've got moats and they got walls and they got drawbridges and they got flaming barrels of oil and all this kind of stuff if they get attacked, right? But the castle represents an economic unit. It's a city, a vibrant city of economic activity, and it helps everybody earn a living and pays the castle owner because he gets to collect the rents and all that kind of stuff. And if it comes under attack, in order to protect yourself, you got to shut it down. You got to raise the drawbridge, et cetera. So some of the larger landlords, they would create more than one structure on their lands, one here and one miles away, which is just diversification. So, back in the day, the marauding bands and armies and stuff, they didn't really divide and conquer. They focused all their energy on one target at a time. So if I have to batten down the hatches here, I still have another castle way off in the distance, conducting business and generating income and, everything that people need. So it's sort of a divide and conquer. So I'm separating, myself from attack. If I get attacked here, I shut down. This one's still open for business. So
got it.
The idea of having limited personal liability, it just means try to separate your personal affairs from your business affairs. So an attack on your business doesn't impact your personal, and an attack on you personally does not impact your business affairs. And I wanted to say one more thing, because I know you're right, Rich, we're running a little long, and just kind of one extra little tidbit about LLCs, because in an LLC environment, you've got to decide, am I going to, if I'm a small business owner, most commonly, I'm going to consider a sub-S corporation or an LLC. Really the most common structures for small business owners, bigger businesses or super high, income earning, doctors or other professionals might incorporate a C corporation, but most of us are going to go sub-S or LLC route. Keep in mind, if your business involves real estate, like investment real estate, never, ever, ever own real estate in a corporation of any kind. Never. It's a tax trap. If you're going to invest or involve real estate, an LLC is generally speaking the preferred way to go. Talk to your CPA, of course. Also, in some jurisdictions, the state won't allow you to form an LLC if your primary business requires a state issued and regulated license.
Understand.
So not every state's this way, but some are. California, I have a lot of familiarity with it. So you could be a licensed beautician, license issued by the state, regulated by the state. You want to open up a salon and you want to incorporate, for liability protection, whatever. They won't let you form an LLC for that. You'd have to go probably the sub-S corporation route. So you need to understand, what options are actually available to you and evaluate. Take this conversation and this structure as a high level, and you can kind of narrow it down to one or two potentially suitable ways that you could form your business, and have your attorney, have your CPA kind of guide you into the process to get you exactly the right structure that you need. So it's important to know that a lot of this involves a little bit of advanced planning, but it could also involve the sole proprietor that's been running that shop, running that business, running that auto repair, whatever it may be. And he's like, okay, I'm getting to the point here where I'm getting killed in taxes. I just got notified I'm going to get audited. Or you've heard about other people in your space that are sole proprietors that they got the audit knock on the door and just like, I want to avoid that. One of the best ways to avoid that is to incorporate in some fashion, right?
Understand.
And so if you guys have any questions that we can help answer, or
we wanted to very, very quickly finish up by, since we're all about estate planning here at AmeriEstate, how does this LLC or this corporation, how does it find its way to my living trust and probate avoidance? That's important, correct?
That is important, and it's something that you and I think about all the time, because you're right, we're very focused on all things estate planning, and not everybody is for some reason. But the idea is that if you have a living trust, part of the function of a living trust is to provide continuity of management over your affairs in the event of, serious illness, incapacity, or death, right? We talked about the sole proprietorship being maybe a little bit more difficult for that continuity to occur if any of those things happen to you. And so when you create a more formalized entity, it involves an ownership in the company. So my ownership would be represented by shares of stock in a corporation, or in membership units or membership interests in an LLC, or in partnership units or partnership interests in a partnership. Ideally, those ownership interests should be acquired in the name of a living trust, because the living trust then provides some continuity of management. You retain the trust has the voting power now. And so whoever's in charge of your living trust, you as trustee while you're alive and competent, maybe, and your successor trustee, which could be a family member or a professional or whoever that represents the interests of you and your family, who can receive payments, cash those checks, participate in the sale of the business without a lot of extra court involvement, vote to elect the managers or replace you as the manager, so we can immediately have somebody in charge without having to go through a long drawn out probate process.
Great.
So the idea would be that you form the entity. The entity owns the business and the assets that the business has directly, but you own the entity through your living trust. So your ownership of the entity is your living trust, and then the entity itself owns the assets directly. And that's how you separate yourself from liability, and that's how you maintain control.
Got it.
So thank you for that question.
Thank you for that. You know what? Contact AmeriEstate. We create these entities, we counsel, contact AmeriEstate for a consult. There's no one size fits all. We'll work with you to get you into the right entity, but contact AmeriEstate. We're always here for guidance and counseling and to actually form the entity. We want to thank you, Greg Reese, for being with us today to help sort this out. We really appreciate it. It's a big arena, and we wanted to get a little background on and know what we're doing here. So thank you so much, Greg. Thank you all for participating very much, and we look forward to hearing from you. And thank you for your time today. Talk to you soon.
Yeah, it's been a pleasure. Thank you, everybody. Talk soon.
Good job.